Hey guys, welcome back to another episode on financial lessons. Um, so today I just want to quickly touch on the latest news, I guess, on financial situation in the US, and you will have a um what I would call probably a multiplicative effect across the globe, across the financial world. You know, in major financial market, Europe, UK, um, because this is big. Today, I'm not gonna just there's so much to talk about in what just recently happened, but we don't have that kind of time. So I will break them up. I will do different episodes to touch on the different um facet of what just happened and the implication. So if you follow the news at all, you probably heard about the Silicon Valley bank collapse, right? You can look up the numbers. There's anywhere between 160 something billion dollars to 300 something billion dollars that was deposited in the bank that right now has been taken over by the FDIC and the federal government. The bank has literally been shut down. So if you had any kind of deposit in that bank, you can't get access to your money right now. The reality is that most of the people that deposited the bank, because this bank is in California, it's Silicon Valley Bank. Most of them is tech startup and tech firm and investors and venture capitals, people that like to put their money, technology. Apparently, this bank is one of the um, major, I guess, major seed funder. When I mean seed funder, I mean it's a major bank where most of the money for startup is, it's been a very good bank in terms of being able to provide capital for startups in Silicon Valley and the rest. Right. So all of that you can look up the history and you know and you can get as much detail. But what I want to touch on more importantly is the lessons that we can learn from this. Okay? You'll hear a lot of people saying, who is the federal government because the Federal Reserve raised interest rate. And some will say because they raise it too quick, the interest rate is high. Look, there's nothing, if you're a finance student, there's nothing, none of this is secret, right? The Federal Reserve never guaranteed that they would never raise interest rate on bonds. So, you know, which bring me to a critical point. I just want to touch on that it just kind of crossed my mind is that this bank was heavily weighted toward government bonds, treasury bills. So let's touch that on a little bit. Yeah, government bonds and treasury bills generally always considered to be low risk to no risk. Look, there's no investment that is risk free, as clearly it's been shown here, right? They as no matter how good the federal government, no matter how good the economists are, no matter how good the business analysts are, no matter how good the macro system is, you can look. There's so many factors that can shift the macroeconomy from one end to the other end. It could be a pandemic like COVID-19. You know, it could be anything, natural disaster. It could be a political. It could be a war in Ukraine. You know, So there's nothing that you can say. Oh, the Federal Reserve can never say, oh, we're never gonna raise interest rate because you know why? There's inflation. Inflation. I mean, there's so much to talk about. So I'm just gonna. Inflation, for instance, can be caused by a number of things, like I just mentioned. COVID-19, war in Ukraine, high gas price, all of these things can cause inflation, and the Fed has a responsibility to try to, tamper inflation. So what do you expect them to do? because I don't even know if the Fed really knows how many banks is heavily weighted toward bonds. I don't know if they have that statistic. But did we expect them to not raise interest rate to fight inflation? At least that's the tools they, they excuse me, they claim that is the best tools to use to fight inflation, which that's a whole different topic that we can talk about at a different time. But if they choose to use interest rate to, what do you want them to do? Not to do it, so that the price of things continue to skyrocket? This, of course, the funny thing is that all of these different levers and all of these different indicators and all of these different, tools that the Fed might have that they might want to use to try to fight inflation, they do have, unintended consequences. Some of them are intended consequences, some of them are unintended consequences, and there are more to come. There's unemployment expected, because when you slow down the economy, you know people, demand slows down, and there's probably be a little bit more supply, but the demand is down. There's not enough money. People don't have enough money to spend. Employers will lay off people. So there's potential for higher unemployment, right? And there's the consequences for higher unemployment. I mean, the process just keep compounding on each other. So blaming the government is not the best strategy. Bond interest rate will go up or go down. You know this. If you tell me you don't know this, then I don't know what you're doing in the business in the first place, in the finance business in the first place, right? My concern is that why they were so heavily weighted. And when we say heavily weighted in finance terms, it means that you put more money into one asset more than you put on the other asset, right? I don't know why they were so heavily weighted toward bonds. Yeah, I guess the notion is that it's free and safe is federal government bonds. How bad is the US bonds? Huh? I mean, it's almost guaranteed, nothing risk free. But is it true? Is bonds really risk free? They're not risk free. They're not, as we have seen. They have a different kind of risk. And this is it. Inflation is a key risk to bond. People should know that now. If they don't know, inflation is a risk to bond. So unless you can continue to maintain inflation at zero level or point something level, then you can never say bond is risk free. Because the higher the inflation, the higher the interest rate is going to, because that's the theory and that's the thought process behind it in terms of fighting inflation. So think about that, guys. So the point is that, right now, where is your money safe? I mean, I've always been worried about banks. That's just my personal, because I always feel like one day you're gonna wake up tired to go to the bank to get $50 out, and you find out that your card doesn't work anymore. The bank is shut down. It doesn't matter how big they are. It can happen to any, because all these banks are almost intertwined in a way. They invested in the same thing. They invested in bonds, they invested in commodities, they invested in the stock market, they invested in alternative asset. I mean, the whole global economy is all tied in. The key is diversification. So a bank that is heavily weighted toward one end, I feel like they were almost greedy. I mean, it doesn't seem like they were greedy because they were invested in bonds, but to to put a hefty share of your capital toward bonds, because at least you're gonna get what, 2% normally on the interest on the bond. You're gonna get 2% payment consistently. So you might not seem like they were greedy, but if you think about it, they were greedy. Why would you put so much money into bonds? It seems safe, but is it really safe? Unless you want to make that money. At least it's almost like a passive income for the bank. They could have taken that money and loaned it out to people for that same rate, even higher rate, but they won't. They probably won't. So anyway, guys, the lesson here is that if you're going to invest, diversify your portfolio. If you're going to invest, and this is not only affecting people that had deposit on the bank. It also affect people that actually had the stocks of this bank, right? So which bring up another point. If you're going to buy stocks for any company, look at the financial record. Look at the financial record. Look at where their assets are, where their investment are. What are they doing with their money? Where is the cash asset that they have? Where did is it? Are they sitting on it? Is it on what we would call reserve earnings? Is that what it is? Are they sitting on this cash or are they invested? And because if you look at it, you see on the um um it's not the operating capital. Is you have normally you have uh three types of source of capital when it comes to financial statement, right? You have the operating capital, you have the financial capital, right? And you have the investment capital, right? If you look at the financial capital, you see what kind of loans they have, if they have any, if they're taking any loans, right? You see that. You see if they're selling any stocks. You see if they're buying stock. If you look at the investment capital, right? You see if they're buying stock. So you look at these two sections of the financial statement, the financial capital, which mainly has to do with how are they getting capital into the business, right? Is it through the banks, other banks that they're borrowing money from? Is it through by selling stocks, right? Is it through by selling corporate bonds? Or the investment capital? Where are they investing their money? Are they investing their money in stocks, in bonds? So, just anyway, there's so much, and when you come to the individual financial statement, knowing the financial statement, because then you throw this into a bubble of the tech bubble or whatever you want to look at it, whether it's a bubble or not, but the tech business whereby most companies are way two, three, four times of a value compared to what your book value is. Because people are investing in what the future potential of the company will be, not on what the company is currently valued at. You know, so guys, anyway, I don't want to take so long on this. It's unfortunate what just happened, and I think you're going to start hearing things like unrealized losses. Yeah, unrealized losses. What that means in a nutshell is like a stock or bond or any investment that a company has that has lost value, but they have not sold their share of that company to actually see the actual loss. So it's possible that that unrealized loss can turn out to be unrealized gain in the future if the stock or the bonds interest rate goes down or the stock price of whatever investment that goes up in value. Right? So you're gonna hear stuff like that. Those are just them to throw you to confuse you. Long story short, that it's either you've sold or you haven't sold. That's just what it is. You sold, you lose. You don't sell, you still technically you haven't lost yet because things can turn around. I hope things can turn around. But anyway, guys, thank you so much. We have so much to talk about in the future regarding all this stuff right now. And it's unfortunate if you have money in this bank. Well, hopefully, if it's under 250,000, the FDIC should cover it up. Above that, there's kind of all kinds of mechanisms trying to get into play now to see if people can get their money or whatever the case might be. But the lesson has been learned. I mean, it's a tricky times, right? Be careful with your money. Really, because I don't know where you can hide your money, where you can keep your money that will guarantee the safety of it. But let me leave with one last advice. I feel like inflation is the reason everything is happening, right? People trying to invest in the stock market so that they can beat inflation. Their money can still retain the same value. You know, people are trying to invest in bonds because it's a bonds. Even the bonds is in situation like this, the return on bonds, unless the interest rate has gone up, is less than the inflation. So if you invest in bond, you're actually getting lower than what the inflation. You're not keeping up with inflation. So let's just go. I think the best thing for the government or for people to do is government and the private sector to do. Private sector, remove greed. If we remove greed, people are becoming less greedy. People will sell things at a reasonable price and produce enough instead of creating what in economics we call artificial scarcity, right? People are doing that, creating artificial scarcity. Go from any commodity, from energy to you can name it, right? What happened to equilibrium? Supply equals demand. What happened to the basic law of supply and demands in economics? Produce enough to meet the demand. Produce enough that is equal to what people are demanding. Not overproducing it, not underproducing it. What happened to all of that loss? Anyway, we need to go back to basic. Produce enough, give people good pay so that they have enough money to buy the thing that is produced, so that we don't have more money chasing less good causing inflation, or we don't have too much goods and less money, right, causing a fall in price to the point that people start losing job, which the whole system repeat itself again. Anyway, guys, thank you so much for listening. I hope maybe you've learned one or two things. Hey, if it's safe, keep your money in your house. Put a little bit on the card. At least for necessities. At least you know where your money is at. Sure, put it in the bank if it's under 250,000. Hopefully the FDIC will pay you back. You have a choice. This is not a financial advice in any way, shape, or form. This is just my opinion of the way things are. All right, thanks, guys, and hope I'll talk to you guys later. Please don't forward this video. Don't forget to like the video and subscribe for more content. All right, thanks. Bye.